Hi everybody, here for part 2 of your psychology series, I'm going to call it, for your Mortgage Minute. Julie Shermito with JS Mortgages at The Mortgage Advisors. What I had just talked about in my first part was the fear that we feel when we read the headlines about what's happening with interest rates. I want to talk a little bit about the psychology of why the Bank of Canada is doing that. So Bank of Canada's target and the Fed is in the States, their targets are to keep inflation under control. That is their mandate. That's what they're working towards. 2% is their inflation target. We are now at 6, 7, 8, 9% inflation. Who knows how high it's going to go. And that's being driven by people spending. So here's a really interesting thing about what the Bank of Canada is doing with their interest rate increases is they are trying to get us to fear a recession more than we fear inflation. And I'll explain that a little bit. When we fear inflation and we see those numbers and we think what's going to happen next is that things are going to be even more expensive, we go and buy a whole bunch of things, which is this self-fulfilling prophecy of what's happening right now. We're seeing prices go up because people are anticipating that prices are going to be more later, especially people who are in manufacturing, or if you're running a small business, you're thinking, I better go and I get all of the things that I need now because it's going to cost me so much more later, which then of course increases demand. And then this drives prices even higher, and then inflation goes higher, and so. When the Bank of Canada increases their overnight rate and the banks, the chartered banks, increase their prime rate, or the other lenders that are doing mortgages, any kind of loan product is going to be based on the bank prime or the lender's prime. When they increase their prime rate, we pay more to borrow. So whether it's a mortgage, a line of credit, a credit card, potentially some credit cards, those are all going to be more expensive. And if we're paying more into our mortgage, we're probably going to spend less on other things because we have to start doing a bit of a trade-off. That's the psychology that they're working on. They're trying to create the need or the idea for us that, holy cow, inflation is actually going to end and now we might end up in a recession, and I'm just going to hold off on spending, either because my mortgage got more expensive so I really have no choice, or I just don't think things are going to be as expensive later. That psychology is what is going to bring inflation back down, and then the Bank of Canada can put a little bit of a hold on this. So this isn't really about them controlling something that's totally out of their control. The supply chain, the war in the Ukraine, China's lockdown policies, all of that is impacting our supply chain, which is impacting the cost of goods and services. And all of this is this big chain event the Bank of Canada really has no control over. But what they do have control over is what we think is going to happen and what we as consumers spend money on. And the last couple of years, we have been spending. We've been borrowing for almost nothing. And so it feels like this free for all where we can holy cow, I'm hardly paying anything on my mortgage. So then I can go and I can get my Starbucks every day, or I can put my kids in a bunch of extra activities. That mentality has been great and served us for the last couple of years, and it helped bring businesses back. But now we are on a bit of a runaway train. So the psychology of spending and the psychology behind inflation, as it's been explained to me by people who are much smarter than me, is if we fear a recession more than we fear inflation, we will in turn bring that inflation down. So Bank of Canada at that point could halt their increases as a result. Okay, stay tuned for part 3.